Okay, good evening, everyone. Welcome back to our online live sharing class. I'm very pleased to meet with you all here like this during our live sharing classrooms every time. Now, whether it's in the past live sharing sessions that we've done, or present, or in the future of these classes, I love to explore and teach about stock trading knowledge together and share my personal insights and experiences. Now, of course, each time I share with you all, it's also a process of me re-examining my own knowledge's framework. So in this sense, I'm very grateful to all of you. At the same time, I hope you can find some joy in trading here and can truly earn more profits together. Our live sharing class is just like a big family full of inclusiveness and mutual assistance spirit. Whatever difficulties or problems you encounter in the trading process, please feel free to seek help and answers from me or anybody on my team at any given time. I believe that with everyone's efforts, each member can achieve their own value and wealth goals in this market. So let's continue to push and encourage each other. All right, let's officially begin today's class. All right, so the contents we're going to be going over this evening is going to be presented here. Now, in terms of framework, basically the content we share every night now has a certain degree of similarity. Now, of course, this is only in terms of the framework. The actual content itself has fundamental differences. Now, last week we participated in an IPO subscription. One of the stocks has already been listed, and if we sold today, it could generate us a profit of over 50%. The other stock, which will be listed tomorrow, and we anticipate a minimum profit of 200%. Now, this is based on signing relevant business contracts. Most of what I need to tell you, I have already shared previously. What I haven't mentioned is essentially confidential things will fall under business secrets. Now, I appreciate your understanding at this point. Today, I want to introduce another Wall Street legend, another master to you all. Now, this master is quite different from all the other ones that we have talked about in the past. This one is a global investment guru. His name is Jim Rogers. Many reasons why people ask, why do we call him the global investment guru? Now, this guy, he loves traveling around the world and investing, learning about cultures, really cool stuff. So in a moment, we're going to go over this in more detail. So for now, we're going to start off this evening with our macroeconomics. Okay, so tonight we're going to start with analyzing and sharing the fundamental aspects of the major news and financial data. Now, as everyone knows, today is the day when the election results are going to be announced. Since we are trading Indian stocks, the content we share tonight is mainly about some political and economic situations in India. Of course, as a qualified investor, we usually do not have political preferences, but only focus on profit opportunities. Now, of course, personally, I love India, and it has nothing to do with the politics at all. We have long known that there is no suspense about domestic general elections in India. It's just about the number of votes received. So we're not going to get too much into that, but most of the news is going to be surrounding to this somewhat, right? Okay, so first piece of relevant economic and financial data within India, domestic news, India Q4 GDP data, so Big Bang ending for fiscal year 2024. In the fourth quarter of last fiscal year, so quarter four, fiscal year 2024, India's GDP grew by 7.8% year on year, maintaining its robust growth momentum, slightly lower than the 8% growth rate of the past three quarters, We also see that the GDP growth rate for the previous quarter was revised upward to 8.6%, mainly due to a roughly 50 basis points upward revision in the private consumption expenditure. Now, this marks a continued growth momentum in economic activity this year, exceeding all market analysts' expectations. So, what does this imply? The data from the fourth quarter indicate that the GDP growth for the fiscal year 2024 stands at 8.2%, which is 0.4 percentage points higher than our forecast for this year. Now, I want to keep one thing very clear. Any differences in expectations and actual numbers, even if it's 0.4%, it is a huge difference. So this surpassed the second estimate of the 7.6% and the Reserve Bank of India's forecast of 7.3%. Now, the data shows that the GDP growth in the fourth quarter was a mixed bag. According to the expenditure method, the growth in GDP in the fourth quarter benefited from steady growth in private consumption expenditure and robust export growth. High-frequency indicators for this quarter indicates a widespread improvement in private consumption expenditure. Sales of two-wheelers and tractors showed healthy growth this quarter, while fast-moving consumer good data indicate an improvement in rural consumptions. At the same time, domestic air passenger traffic and index of industrial production for durable consumer goods, growing at 11.2% year on year, suggests healthy urban demand. Now, export growth reached a high of 8.1%, the highest for the fiscal year 2024. Now, this contributes to an increase in net exports contribution to GDP. Gross fixed capital formation grew by 6.5% year on year, indicating a slowdown in investment growth momentum for the remaining part of this year. Investment growth rate has remained above 8.5% for the past 3 quarters. The slowdown this quarter could be a result of geopolitical tensions and uncertainty brought about by national elections, impacting investment decisions. We expect this to be temporary, and the formation of the new government, strong growth may stimulate an investment rebound. Now, looking ahead, we hold an optimistic view on the growth for the next fiscal year. Although there might be modest growth in the first quarter of the fiscal year 2025, due to the election activities, we believe that the economic potential, as seen from the GDP growth of the fiscal year 2024, will help India return to a robust growth trajectory. Additionally, later this year, synchronized global growth and improvements in global liquidity conditions as Western central banks ease their monetary policy stances will further boost our exports. Currently, all eyes are on the incoming new government and the upcoming budget announcements, and it is anticipated that India will develop unrestrictedly thereafter. So we emphasize once again that the fundamentals of the Indian stock market are positive. The foundation of a bull market has always been present and thriving, and the issues faced now are simply increased short-term volatility, which of course can be somewhat damaging for regular traders. This is again why I've said let's stay away from the regular stocks. Very volatile during elections, so we're going to continue pressing what we've been pressing. Second piece of news: India's Modi plans post-election reforms to rival Chinese manufacturing. According to two informed government officials, the Indian Prime Minister Narendra Modi plans to introduce a series of measures favorable to business development if he wins a third term this week. Now, including implementing regulations to make it easier to hire and fire workers. The official, who declined to be named, said that part of Modi's election promise to transform India into a global manufacturing hub, He aims to provide subsidies for domestic production, a model similar to recent subsidy programs for semiconductor companies and electric vehicle manufacturers. Because he was not authorized to speak to the media, the official chose to remain anonymous. Now, in fact, although I have not seen the election results so far, I just know they have a majority seats as well, or have not had a chance to pay attention too much. According to the exit polls, Modi's right-wing alliance led by the BJP, India's Nationalist Party, is expected to win the vast majority of votes. Now, Modi's re-election campaign is built on the commitment to sustained economic development. He positions India as an alternative choice for multinational companies to diversify their supply chains and reduce dependence on China. India is the fastest growing major economy in the world. However, according to Josh Feldman, former head of the International Monetary Funds Office in India, the country has both a thriving tech sector and a struggling old economy. Failing to provide enough job opportunities for everyone. Feldman stated, the way to provide employment opportunities for these people and offer good job now is through manufacturing. India has successfully attracted supplies of major US companies like Apple and Google under Alphabet Inc. However, data from the World Bank shows that India's share of global manufacturing is less than 3%, while China's is 24%. An internal document seen by Reuters suggests that the Indian government plans to increase India's share in global manufacturing to 5% by 2030 and 10% by 2047. Now, the document did not provide specific details. Therefore, India still has a long way to go to truly compete with China in manufacturing. Now, of course, we should also see the other side of things. India's relatively low share in global manufacturing leaves room for significant development. With a greater space for manufacturing development, there will be a larger room for economic growth, possibly laying a solid foundation for a long-term bullish market in the Indian stock market. This is both an opportunity and a challenge, but I believe in India's development and it will definitely start to soar again. All right, last piece of news. Manufacturing PMI eases to 3-month low on heat waves, higher production costs. Now, a private survey shows that after reaching the highest level in 16 years in March, manufacturing activity in India slowed down for the second consecutive month, in May to the lowest level in 3 months, but still higher than the long-term level average. Now, in May, the HSBC India Manufacturing Purchasing Managers Index dropped from 58.8% in April to 57.5% in May. Now, indicating that while the health of the industry is improving at a slower pace, there is still significant improvements. The data for May shows that factory production in India continued to rise, extending the current expansion period to nearly 3 years. Now, evidence suggests that growth is supported by new business expansion, strong demand, and successful marketing efforts. The report attributes the economic slowdown to reduced working hours and increased production costs due to hot weather. Now, similarly, new orders also saw a significant growth. Although at the slowest pace in 3 months, the growth is attributed to marketing efforts, strong demand, and a favorable economic conditions. Competitions and disruptions related to elections reportedly hindered growth. Now, contrary to the trend of total sales, new export orders in May grew at a faster rate. This is the strongest momentum in 13 years, with Indian manufacturers showing the most positive sentiment towards growth prospects in nearly 9.5 years. Confidence was boosted by continued strong sales performance, optimism about growth prospects, advertising, and innovation, and expectations of favorable economic and demand conditions. Now, persistent strong sales performance along optimistic growth expectations drove employment growth in May as well. Employment growth, along with rising costs of raw materials and freight, contributed to the rapid increase in input costs for manufacturer. Now, have you all seen this data? Despite the slight decline, the manufacturing sector is still in a high growth state. Now, of course, I hope that during times of high economic growth, there will be further strengthening in livelihood recommendations to ensure that every citizen can benefit from the dividends of economic development. All right. So that's 3 pieces of general idea and news of what's been going on domestically, what our manufacturing plans are, how are the manufacturing plans currently is right now, things like that, right? So everything is always talking about growth, and that means we are growing. All right. Now it's time to review the performance of our domestic stock market in India, so our Nifty 50 and our Sensex index. Now, the market trends, you all can see it clearly without me having to say too much. Now, I predicted the market's reverse fluctuations, but I never expected the decline to be this violent. Now, I think such performance in the market should be beyond the expectations of all investors. Of course, this is not the most important thing. I've mentioned before that whether the market goes up or it goes down, that is not the most important thing. Now, what is the most important thing is that investors should know what they should be doing at this moment themselves. So, faced with such a decline in the market, what should we do? If you are an old member and been following us for a long time, you should already know that we don't need to think about what to do now because we've dealt with this problem a while ago already. I told everyone not to trade in common stocks and to sell all the stocks and your positions when you had the chance. If you followed that advice, then these sharp declines and these high volatility has nothing to do with us. And the market cannot pose any threat to our funds or our capital. Am I right? Now, on the other hand, our wealth growth plan, the trading projects we are engaged in, are also not significantly impacted by the index. Even though we paused once today in trading in stocks, that may halt trading at a high uncertainty point. So think about it. Aren't we pretty comfortable? Aren't we pretty safe? We've exited all our positions in the stock market. I believe everyone naturally is going to have an answer in their mind if they followed us along. All right, so without further delay, let's jump into our Nifty 50 index. Okay, so today the index opened lower with a gap down and then started a sharp decline pattern. The intraday maximum decline at one point exceeded 8%. By the closing bell, it still maintained a nearly 6% decline, which is the most in the last 4 years. Now, apart from small intraday bounce in the afternoon, the bulls were completely overwhelmed to the extent that there was even an incident of trampling between the bulls in the morning. The fundamental reason for today's market decline is that the alliance led by Modi's party won a majority of seats by a weaker margin than expected. So greatly disappointing the market, leading to today's crash. From a technical perspective, at the close today, the Nifty index fell nearly 6%. It has essentially shattered the bull psychological defense line, and the intraday decline should be one of the largest in recent years, which has a significant impact on the market. Even the support line, the previous uptrend channel, has been broken. Now, of course, the market is still unstable at the moment. Since I have to share this online class with everyone, I do not know the election results yet. Even if I find out, it would be necessary to wait for the market to digest this for about 2 to 3 trading days before even reacting to it. From the technical support and resistance level, they have not been studied for now, because in the face of major event, any support and resistances are futile unless it's a long-term support line, but that is too far away to be a substantial significance as of right now. Now, whether the market is going to be clear or unclear at present, we just need to focus on the wealth growth plan, which also reflects the advantages of our asset management account and trading strategy. Okay, so that is all I wanted to talk about with the Nifty 50. Lots of red, lots of volatility. We've been talking about it for weeks leading up to this point. All right, let's take a look at the Sensex index. Today, this index also experienced a sharp decline. However, although the magnitude of the decline in the Sensex index is not greater, graphically it appears more intuitively bearish. So from a technical chart perspective, we can clearly see that the uptrend channel since January has been completely broken downwards. Though it may seem that there are some technical supports near the previous low in the short term, as I mentioned earlier, such technical support is meaningless. For the future market direction, two important conditions are necessary for judgment. So firstly, we need to wait for the actual election results to be announced. Secondly, we need to observe the market in the short term to see how the election results will impact our market. Now, you might think that I'm overly pessimistic about the market at this point. However, I can responsibly say that's not the case at all. In fact, I have great confidence in the medium to long-term performance of Indian stock market. Another point is that the time frame of the medium to long term that I understand may differ from what others perceive. In the short term, as the adverse impact of the election on the market already exists, it is unlikely to change. So even if today's election results were to improve, it would not completely reverse today's significant decline in the short term. So generally speaking, in the coming short period, it will be very challenging for ordinary investors or traders in the stock market to make money easily. Nonetheless, it is good news for us because we can focus more on executing our own wealth growth plan. Plus, for some new members, even if they lose money in regular market trading, they can make up for their previous losses through our plan and also earn more than what they have lost. Often turning losses into gains is something that brings great joy to people. You recover a great deficit, you know? Okay, so this is the analysis of our Nifty 50 index as well as our Sensex, as well as the strategies and how to deal with the market. My suggestion is kind of stay out of it until we have a little bit more information. Let's watch all these corrections after the elections and see what happens. I hope this has been helpful. If there are any areas you don't quite understand, please feel free to contact my assistant directly. Let's continue to study the next part. Now, in order to ensure the smooth implementation of our wealth growth plan and to reap more profits, last week we applied for the IPOs of two companies. One of them is VLS Transcore IPO, which started trading yesterday. Though we didn't get a large allocation for this IPO and maybe only a few people got allotted shares, still, we have managed to earn a decent profit. It's still a great money-making opportunity. The other IPO is ZTech India, which was initially scheduled to start trading today. However, due to an exchange rescheduling, it has been postponed till tomorrow. Although there is a day gap now, it's not surprising for all of us. This delay is normal occurrence. On the positive side, the profit potential of this stock post-listing is quite certain. This IPO also a key focus on our current IPO project. We have made appropriate arrangements both in terms of profitability and allotment of shares. I believe everyone can achieve more profits. So why don't I mention this to everybody, right? Of course, I didn't tally the final allotment results as viewing it from perspective of a random allotment right now. Now, regardless of whether we eventually get allotted shares and how many shares we get, this is just one of our numerous profitable trades. There's going to be a lot more profitable projects in the future. So I want to emphasize again that for those who have been allotted shares but haven't completed the payment yet, please make sure you complete the payment within the specified time. If you have any questions or need assistance, feel free to contact my assistant. Now, regarding what kind of company ZTO is, we all have already talked about it before numerous times, but there's still a few people here who hope to understand just a little bit more, or maybe they feel that their previous understanding was not sufficient. Now, it's a simple understanding of this is enough for everyone. So I'm just going to briefly go over why we like this IPO so much, what they're about. After all, this IPO is going to be listed tomorrow, so we're all just going to have to wait to make money, right? Now, ZTech India Limited initially designed civil engineering products and services offering advanced geotechnical solutions in the field of infrastructure and civil engineering projects in India. At the same time, the company is committed to implementing innovative wastewater management solutions for industrial units using cutting-edge GEAS technology. Now, this dual commitment underscores its holistic approach to sustainable practices, converting waste materials into recreational spaces while effectively managing industrial wastewater through state-of-the-art technology. It aims to provide customers with innovative, safe, and environmentally friendly engineering solutions. Now, currently, the company's main sources of revenues or profits are sustainable theme park development, industrial water treatment, and geotechnical solutions, creating a very, very niche market. Presently, the company is mainly focused on sustainable theme park development, which is a high profit category. This part itself accounts for 60% of their revenue. The work and theme park division has boosted its revenue and profit for the fiscal year of 2024. Now, in fact, the future of the company is very promising. After the IPO listed, the prospects for its stock's price development are also very promising, considering its strong fundamentals, which will support a high stock price performance, especially when agreement we have with the lead underwriter for the stock price appreciation. Now, this is updated up to as of May 31st, which was the third day of subscription, which is also the deadline for the subscription. Now, ZTech India IPO has a total subscription of 371.39 times. Among them, the public offering has been subscribed 315.59 times. In the retail category, 123.10 times. In the QIB category, and 832.37 times in the NII category. Although the subscription has already closed, the total subscription reaching 371.39 times is quite impressive. This data shows the high level of enthusiasm for this IPO in the market, which is why obtaining the corresponding subscription allocation is relatively difficult. From this perspective, everybody should understand, right? Now, what I want to mention is even for our institution, it is quite challenging to get a profit allocation. So can you get an allocation with a regular account? It's basically unlikely unless you have exceptionally good luck. So moreover, as we mentioned before concerning ZTech India IPO, we have signed an agreement with the lead underwriter for a stock price increase after the IPO listing. At the same time, a 200% profit is going to be guaranteed. Of course, you won't have to wait too long. This IPO will be listed tomorrow. So once again, I want to remind those who have allocated shares that have not fully paid for their shares amount to promptly make the payment. If you have any special questions or difficulties, just contact us. Okay, so regarding to the ZTech India IPO, it will debut tomorrow, so we're not going to talk about it much, and we're just going to watch it as of starting tomorrow. So next, we're going to continue to share about investment achievements of the investment guru Jim Rogers. So, who is Jim Rogers? I guess not many of you have heard of him before, right? So Jim Rogers was born on 1942. He learned to make money at the age of 5. So he once ventured into Wall Street with $600 and later co-founded the Quantum Fund with Soros. Soros was somebody we talked about before, right? Now, achieving a profit margin that once reached 3,300%. He traveled around the world twice, but his ultimate goal was not tourism, but global investment research. He thereby established a Guinness Book World Record and created an investment record of trading stocks in over 10 countries. Now, this Jim Rogers, he is a genius investor born into an ordinary engineer family in Alabama, USA. Although there were no relatives in his family who worked in finance industry, Rogers, with his innate passion for investment, influenced the world financial markets and eventually became an investment guru on par with Soros and Buffett. Now, isn't such a guy worth learning from? Of course he is. All right, so let's talk about who Jim Rogers is. A famous American investor, an economic analyst, university professor, and a writer who co-founded the Quantum Fund with Soros, is renowned for his investment in commodity futures and is known as King of Commodities. He graduated from Yale University and Oxford University, a prominent figure in modern Wall Street, hailed as one of the most visionary international investors and one of the most successful practitioners in American securities industry. Now, from the terrifying Quantum Fund he co-founded with financial giant Soros to the thriving Rogers International Commodity Index, the RICI, from 2 global investments being featured in famous yearbooks like John Train's Money Masters of Our Timeline, Jack Swagger's Market Wizards, everything he has achieved has left people in awe. Now, compared to Buffett's calm and seasoned demeanor, Rogers appears to be sharp. He's agile. Compared to Soros' swift and decisive style, Rogers seems composed and cool. Now, compared to the Gross's deep foresight, Rogers comes across as a straightforward and very decisive. But in the international financial world, Jim Rogers rides the wheel of fire of the stock and commodity markets, winning at every turn. People admire the wealth and abilities of this most visionary international investment patriarch, and they follow his winning investment strategies eagerly. All right, so who is this mysterious big shot, right? Roger was extraordinary since he was young. With a talent for investment, he started his business at the age of 5, making money by picking up empty bottles at baseball games. At the age of 6, he borrowed $100 from his father as startup capital for business, purchased a peanut roaster, and cleverly obtained the franchise to sell drinks and peanuts at juvenile baseball league matches. 5 years later, paid off the debt, left behind the roaster, and deposited $100 into his bank account. Keep in mind, when he was young, $100 is a lot of money. Now, during the Korean War, prices surged. Him and his father invested the entire $100 into calves, whose prices were skyrocketing at the time. But after the war, the investment in calves was entirely wiped out. So this was kind of a bitter defeat that made him doubt the world and swore he truly wants to learn and understand the world of finance, of money. Now, of course, at the time, he did not know commodity curves, stocks, or even what Wall Street was. So, while he was studying in university in 1964, he got to know what Wall Street was about. During his university years, he worked at a company on Wall Street in the summer due to predicting that the Chilean revolution would cause copper prices to rise and the company boss gave him a large sum of money to play with. He realized that understanding the world could also make money, which greatly inspired him and made him fall in love with Wall Street. Rogers studied political science, philosophy, and economics at two prestigious institutions in Europe and America, Yale University and Oxford University. In 1968, with only $600 in his pocket, he officially arrived on Wall Street to make money through understanding the world. He tried to grasp as much information as possible on the global circulation of funds and goods and raw materials to find money-making opportunities. Shortly after, he joined the Quantum Fund founded by Soros. Now, in this fund, Rogers was responsible for investment analysis while Soros made investment decisions. The two worked in harmony and became a top-notch duo in the fund industry. With the fund thriving and performing outstandingly, by 1980, the fund has grown considerably, but differences arose between the two on its future direction. At the peak of his career, at age 37, Rogers retired from the stock market, choosing to invest the millions he had made in the market independently. So he's going to go do his own thing now. When he left the stock market in 1980, Rogers claimed to have several $million, while his mentor, Neuberger, stated that his income upon leaving Soros was $14 million. What an incredible journey. All of these guys always start from humble beginnings, you know? So Karl Marx said, "Money is the root of all evil." Rogers also believed that if one understands the issue of money, they can almost see through all the political situations. For an investor, if there is a way to grasp a country's pulse, both quickly and accurately, it is through foreign exchange. In places where currency cannot be freely exchanged, they always have to go to the black market to exchange money while traveling. So their experience visiting the black market tells us that the exchange rate of a bank or the official rate is the most important clue to understanding how a government rules a country. If a country's black market currency price is 10 or 15 times its official price, the country is in crisis. Inflation will soon explode, the economy will tend to collapse, and the government will fall. For those who have investments here, escape quickly. Otherwise, you might lose everything. Now, through this story, the thing I want to share with you all is that to achieve better results in investment, sometimes you must look beyond just the investment aspect. The principles of making money or managing risks are often simple and can be learned, not only in the stock market, but in everyday life. The key is, are you fully dedicated to stock trading? Do you consider it the most important profession? Are you constantly using the most favorable conditions around you to improve yourself? So these are kind of the questions you must ask yourself in this business, right? All right, so invest while traveling the world, right? Now, excellent investors need to understand the world. Only by understanding the world can you really make money. So this is a phrase that Rogers often said to the media. Now, the sentence can be seen as his true purpose of risking 2 around the world trips. After the first trip, Rogers wrote the book Investment Night based on what he heard and he saw during the journey, which sold a total of 500,000 copies and was rated by the New York Times as a best-selling book. After the second trip, Rogers did not return empty-handed. He has another book, Adventurer of a Capitalist. Now, with about 400,000 words, was displayed on the best-selling shelves of bookstores around the world. Now, Of course, Rogers did not travel to write books. His greatest gain was probably the enormous investment opportunities he discovered and the gains along the way while he traveled. In Austria, Rogers found that the local stock market had plummeted to half of what it was in 1961. He purchased a large amount of stocks and bonds of Austrian companies. The following year, Austrian stock market revived, with the stock market index skyrocketing by 145%. So Rogers made substantial profit and was consequently honored as the father of the Austrian stock market. So just sometimes right place at the right time. He's traveling. He sees that the country is doing bad. What does he do? He buys at the low, right? Now, in West Germany, before its reunification, Rogers discovered the local stock market completely ignored the continuous and vigorous economic growth of West Germany over the past 21 years and had never experienced a bull market. He confirmed that the West German stock market was entirely worth intervening in, and within 2 years, he made a profit of 3 times of what he invested. All right. So Rogers loved traveling around the world, and he did it twice. He and his then fiancee, now which is his wife, spent 3 years crossing a distance of 250,000 kilometers, visiting a total of 116 countries, starting from Iceland, Turkey, China, South Korea, Japan, traveling through Russia, via Siberia and Mongolia, to 42 other countries in Africa. He went to Australia, New Zealand, South America, and finally back to the USA. So I just want to kind of paint a picture. 116 countries is insane to travel to in a lifetime, and he did it twice. Now, wherever he went, he would investigate the local products. He would learn about their history, their government policies, securities market, and even black market trading places. Traveling the world with Rogers, wherever his eyes reached, you would discover that the world is so rich, so colorful, that so many opportunities to make money, it's like finding gold everywhere. You would encounter some unheard of things. Now, in this traditionally barren land of Black Africa, we generally know that South Africa is rich with diamonds and a democratic system. However, we didn't know that there is a place called Botswana, which shows a vibrant economic development beyond our imagination of Africa. Now, Botswana's exports exceed imports every year, resulting in a trade surplus. Now, what's even more surprising is that the government's budget also has a surplus. A government budget surplus is rare anywhere in the world, let alone in Africa. Botswana has 3 years worth of foreign exchange reserves. This means that if it stops exporting tomorrow, its central bank still has the ability to import for 3 years at the current exchange rate. Now imagine the situation of a country like Italy with its foreign exchange reserves measured in weeks, or South Korea almost depleting its reserves during an economic crisis. So Botswana is truly astonishing. What's even more surprising is that the country's stock market has only 7 staff members and 7 listed companies with very low stock prices and also cash dividends. Rogers immediately bought all the stocks and instructed his broker to buy every stock that would be listed in the future. As a result, in 2022, Botswana was named Business Week as the fastest growing country in the past 10 years. So just by traveling, just by talking to locals, by digging into their culture, he opens himself to opportunities. In June 1990, Rogers arrived in Japan. Now, the stock market and the real estate market in Japan had already started to decline from their highs, and the overheated speculations was starting to stir up the country. At the peak price, the land of the Japanese imperial palace was more expensive than the entire state of Florida. With such outrageous prices only dropping continuously, everyone was already numb to the downturn. So where could there still be opportunities to make money? Amidst a chorus of cries, Rogers remained insightful. He saw the severely undervalued membership of the Japan Futures Exchange. At that time, seats at the Japan Securities Exchange were already selling for $6 million, whereas the membership price at the commodity exchange market was only a small fraction of that. There would be more and more commodity trading in Japan, and at that existing prices, membership prices would skyrocket. Having been in financial markets for decades, Rogers had developed an intuition for buying low. Look at that smile in this picture. Now, to be able to profit from investment, there must be a good social system in place. In places plagued by war or authoritarian rule, the economy will not flourish. People will have issues even feeding themselves, let alone having surplus funds to invest. Faced with unstable political situation or overly regulated governments, foreign investors would have long been scared off. Now, why would they come to invest? So he loathed authoritarian systems. Of course, he did not only advocate for democracy. True democracy may work, may not work. The system that works must be the one that liberates people's spirits and enables them to do a system that allows the market to help people find their way out. Rogers' two global journeys tell us that the free market system is a mechanism very well suited to human nature. Okay, now around 2010, at the age of nearly 70, Rogers still enjoyed traveling around the world, and wherever he arrived at a place, he would tirelessly give speeches or offer his own comments at the local economy. Compared to Buffett and Soros, Rogers seemed more adept at expressing his thoughts, often with astonishing words that were not always mainstream, but unfortunately turned out to be accurate. Rogers said he was someone who enjoyed independent thinking. Back when he was pursuing further studies at Oxford University, Rogers was passionate about engaging in political debates amongst his peers and even openly criticized the British Financial Times. Since the 1980s, Rogers has been a contributing writer for international renowned financial media such as Time, the Washington Post, the New York Times, Forbes, Fortune, the Wall Street Journal, and the Financial Times. Rogers has also hosted the popular CNBC show Your Portfolio. Now, of course, Rogers also holds a respected title as a university finance professor. So starting in 1983, Rogers offered the most popular advanced security analysis course at Columbia University. Even investment master Buffett couldn't help but praise his teachings. In his classes, Rogers always told his students that they shouldn't bother studying economics in school because it was a waste of time and money. Instead of spending the $100,000 on education, it would be better to invest in business. Although there were risks involved, it was a more valuable experience than spending 2 to 3 years in a classroom listening to some professor who had no real business experience. While this viewpoint displeased academia, it earned applauses from his students. A master's ideas only have societal significance when they can guide people's actions. From speeches to writing, from hostings to teaching at a university, Roger has unreservedly shared his investment views and tricks through various channels. So, some people, when they learn or when they make it all, they just want to give back, right? All right, so gonna go over some of his credentials. So I just wanted to point out a few things or what his life resume looked like, right? So born in 1942, born in Alabama, USA. He graduated from Yale University in 1964. From 1964 to 1966, he went abroad and studied at Oxford. After he graduated for 4 years in 1970, he co-founded the Quantum Fund with Soros and achieved remarkable results. After leaving the Quantum Fund in 1980, so 10 years later, he taught at Columbia Business School. So became a professor. In 1989 to 1990, he completed his first around the world trip, which was recorded in the Guinness World Records. In 1998, he founded Rogers International Commodity Index, which as of November 2003 gained 119.73%, surpassing major indices of the same period. So by 1998, he has started his own commodity index. During his second round the world trip in 1999, he invested in Shanghai B shares and achieved great success, earning him the nickname the Indiana Jones of finance by Times Magazine. So with traveling, being a professor, and dominating as an investment banker, this man truly has done it all in this sector of business, of investment, of trading. Until this day, there are still millions of newcomers learning from him. You know, we still talk about him. But like all legends, they have a system and a strategy in place that they follow to help themselves succeed. Now, we don't have much time today, but every master have secrets themselves. So next class, I want to discuss about the 7 trade secrets this man has to offer. What were some of the things he looked out for while traveling? How does he predict the market so accurately? You know, getting to know these masters is one thing, but understand how they do their critical thinking is a whole new level of understanding the financial game. So we're going to dive into that a little bit more next class. So that is all for today's online course. Please go over some of this content, review Soros, review Buffett, some of these guys that we've learned in the past. See, maybe you could pick up a few more things or remind yourself, refreshment course. And then maybe you'll enhance some trading strategies of your own. So our next online class is scheduled for Thursday, June 6th at 7:30 p.m. I hope to see everyone here again. Thank you very much, my friends, for your strong support, and I'll see you all next time.